spend next 20 minutes sharing the overview for the Japan PE market. And then just a quick introduction of myself, but my name is Azusa Owa, partner at Bain Tokyo, and then focusing on the work for financial investors, mainly private equities and hedge funds. And then for the overall messages, I think I want to convey like three messages. First of all, like a very bright spot in Asia, the Japan PE market. So Japan became the largest regional PE market in 2023 for the first time, and then now representing about 30% of APAC deal value. And then PE deals, of course, hit their highest level ever, and accounting for 5.9 trillion Japanese yen deal value, and then doubling the deal value comparing to 2021 or 2022 records. Exits improved, but the distribution has some gap versus the deal generation, so which I'm going to introduce the data later. The second highest message is headroom for growth further. So yes, we hit the highest historical high deal value last year, but going forward, we do see like positive signs for further growth. So for instance, corporate governance, it's been like over time efforts of the Japanese government to change it, but it's been helping the overall market to grow. And then TSE, Tokyo Stock Exchange, focused on the PBR for qualifying the companies. So now more Japanese companies are interested in delisting the non-core assets with the consideration for the optimizing the PBR. And also like M&A code creating space for unsolicited bids. More activists in the space, and then also like increasing the level of companies considering M&A and also like being private. So many drivers actually like indicating the further growth for the future. And then finally, of course, the competition is changing. More funding is aimed at Japan, so more LPs are interested in investing into the Japan deal activities. And then that's, of course, resulted in the changes with the competitive dynamics. So that has implication for what's the future actions required for different types of PE players in the market. Let me now go into the slides like relevant to the messages covered on this summary slide. So page 4, so overall deal, so this chart is showing like the bar chart is the PE deal value in Japan, and the line chart is showing the number of deals. And as you can see, like we have been experiencing the continuous growth, but 2023 is a historical high in terms of both deal value as well as deal count. And then if we look at like Asia Pacific overall private equity investment value by different geographies, and then here we are showing Japan in red. But as you can see, like in 2023, Japan became for the first time the largest PE market in terms of deal value in Asia Pacific, and now representing 30% versus roughly 10 or less than 10% in the past. And of course, that is driven by not only like Japan's standalone relative value proposition improvement, but also some shift of the investors' interest relative to the other geographies in Asia. Despite like deal value has been continuously increasing, we see like more modest movement for the exit. So as we have discussed on the top part, Japan PE deal transaction value has been increasing over time and then hits the record high. However, on the bottom, we are showing the PE exit transaction value, but it's been declined since 2018. And then yet it has some like up and down, but still like being relatively flat since the decline happened in 2018. And then we do see like aging portfolio over time, given the more like in from the deal generation, but like less exit relative to the deal generation over time. So I think you might ask the question, okay, is it different versus what we observed back in 2003 to 2007? At that time, like we experienced a massive growth in the market. We do see the next wave of growth this time. Is it different? We do think like it's different. This time much more stable and the fundamental growth momentum starts. So I want to explain why so from three different dimensions. Like one is like quality of deal supply. The second point is like capital supply, and then also the context of the capital supply, and also the talent, people in the PEP industry. So if I start from deal supply, back in 2003 to 7, global financial crisis, it was more companies delisting the asset that is like poor asset and they're not profitable or not growing. So that was the source of the deal at that time. And now, like in 2024, what is delisted? Of course, like those non-performing asset is a part of it, but like what changed is that because of the corporate governance, like enhancement, and also for example, like activist conversation with the companies, what's coming out to the market is not necessarily the poor performing companies, but those are something like non-core for the company, but actually like under somebody else, like the management, it can flourish as a very successful business. So it's a very different types of assets coming into the market. That's one first thing. The second thing, capital supply. So at that time, like back in 2003 to 7, people saw that Japan is taking off. So more interest came to the market. This time, past performance actually convinced investors to invest to Japan. And then also, like as I mentioned, there is a temporal shift of funding from other places to Japan because of the relative, for example, geopolitical stability or interest rate attractiveness. But this capital supply is more convinced capital supply, which can be more stable over time. And then finally about the talent. It took a while for the Japan PE market to actually develop the professional with the real expertise for the investment and then also like invested asset performance improvement. It was before 2007, it was time to start developing those people. Now, of course, like still limited relative to the prospective market growth, but we have a good bench of seasoned professional in the PE market. So that is actually helping the PE firms to make a good deal and good investment, and they're also like making sure all the value created towards exit. So on those three dimensions, we see like it's very different versus back in 2003 to 7. Therefore, we believe like the growth this time is more like sustained growth that we can expect for the future. So I mentioned about the deal supply, and I mentioned about the government engagement to enable fuel the deal supply growth. So what's going on? So the Japanese government have actually engaged and then helped the deal supply from many dimensions. So one thing is, of course, like governance enhancement to make sure that the Japanese companies make the best optimal management decisions. And also, like, for example, like a stock exchange, they have been encouraging the company to be more competitive from different financial dimensions. And the most powerful one, most recently, is the PBR 1.0. This is important like indication of performance good over. And then Tokyo Stock Exchange clearly announced to the market that what they are looking for the listed company to be a PBR more than 1.0. So this became an important indicator for the companies as well. So they started to think, okay, should I think about divesting my business from this PBR target perspective? And also like guidelines for corporate takeovers by government METI. And then also this is encouraging the companies to consider bona fide unsolidated bids. And also this will enable like a market check on takeover bids. So what we are seeing on the bottom there, first one is like carve out that enhance like PBR and ROE for the company. Second is like most obvious carve-outs public listed subsidiaries because of the Tokyo Stock Exchange communication on the PBR requirement. Third one is activists. So they are getting more and more engaged and more sophisticated on the communication with companies to be more efficiently managed. So they are enabling the non-core asset carve-out. And then also like as a reactions, some companies choose being non-public. The fourth one is mid-cap firms starting to see like downside of being public. So this is another one that actually creating the management buyout and being non-public move in the market. So from deal supply perspective, you might ask, so what is the multiple situation? So stock price have increased, and then EBITDA greatly like has been improving over time. However, as the middle chart is showing, the EBITDA multiple itself has been relatively stable yet in the market. So of course, like going forward, we might expect this to be increased because of the increase in the competition in the market, but so far it's been relatively stable. And then I also mentioned about the impact from activist fund. So on this chart, like what we are showing is the number of companies invested by activist funds by the market cap size. So as you can see, like it's concentrating between 50 to 300 billion. So those are the more like sweet spot for activists to invest in Japan. Why is that? Because if it's too large, it's difficult to be influential to the company because they usually own like 10 to 20% of the share. So this is 50 to 300 billion is relatively like good, big enough, but also like not too big to be influential. Another dimension, like why capital is like coming into Japan. So this is a MOIC comparison across different geographies, and then showing the bar chart as for like average MOIC by country. And then we are showing like both local currency and the US dollar because of the currency impact as well. But what you can observe is that Japan is actually the most attractive country among the major markets in terms of return to the investment. And here we are showing like deal edge-based analysis, but based on our conversation with the PE funds, what they have been observing is actually like the investment return, the performance is noticeably good for Japan market relative to other countries. And it has multiple reasons. One is, of course, Japanese companies have a lot of room to improve from EBITDA perspective because of under management often observed. And the secondary, like multiple is relative to other countries, it's lower. So, and then as I showed like the data before this slide, but that has been lower. But of course, going forward, that could increase. And also like financing interest rate perspective, Japan is relative to other countries. It's a more attractive market for debt lending. So given the market situation, of course, Japan is getting attention from various like financial investors who used to have limited or no presence in Japan market. For example, private equities, Warburg Pincus, Ores, also like on top of PE, sovereign wealth fund or pension funds, they are considering like expanding their investment to Japan. Some of them already engaged like a local professional to make sure like they can be effectively engaged on the deal generation as well as value creation activities in Japan. And some of them have already made the investment directly to Japan. So this is like this market is getting attention from various players who didn't have a presence in Japan before. So of course, the competition is getting more and more fierce. So what's the implication for PE firms? And the implication is different depending on who you are. If you are domestic firms, let's decide like how big you want to be because the market is getting a lot of attention. So LPs are interested in investing to Japan. So if you want to expand your full size fund size, it's time to grow. So how far you want to go. And then also like once you make your fund size like bigger, of course you have to think like a bit differently on like what size of asset you want to invest. And the larger the asset size you target, actually the competition is fiercer because of the relatively smaller pool of larger asset investment opportunities. So how you want to how you can be differentiated, particularly against international firms that you have to compete for that asset class. The middle one, if you are international firms, you need to be further disciplined on managing expectation for the capital deployed in Japan. And then to do so, and then as an enabler, you have to strengthen, of course, sourcing muscle, but also like post-acquisition and exit muscle. Because as the competition gets fiercer and then multiple is expected to like grow going forward. So then you have to make sure that you can really optimize the value from the investment. And that requires your good engagement and good performance on the post-acquisition work. So those are important. And then of course, like the best talent that you have now today is the most important enabler for those like sourcing and post-acquisition execution. So make sure that you protect because everyone is looking at your talent for the next team member. And finally, new to Japan's international funds, market is already has many existing competitors. So we need to articulate what's your differentiation and right to win deals in Japan. And then think through like what's your operating model in the Japan like P market, and then how do you get the right expertise for the Japan market? Is it like you engage local employees or like a senior advisor? How you gonna make sure like you get the right knowledge of the market and access to the market? And then also like it's gonna be a bit longer term play. So think a bit longer term instead of like short. And then consider initial focus on the de-risk the secondary deals, which is expected to come to the market on the constant and also growing way. So in summary, enjoy the tailwind. It's the brightest spot in Asia today. Headroom for the growth, but manage your expectation. And then finally, changing competition. So be aware of the changes in your competition field and then really be ready to compete in the different competitive fields. And yeah, thank you so much for listening. And that's all for my presentation.
Thank you so much for like more than a lay of the land and for sharing. I know you issued this report a bit earlier, so we consider it like a very kind of yourself to share it with us. I just had one small question because we've seen, for example, that Mubadala went into more infrastructure investment, and so how would you say the comparison between the approach of sovereign wealth funds and how they integrate with local players? You have already a certain vision of trends. Do they prefer infrastructure compared to other type of asset class, or is it diversified?
I think the sovereign wealth fund, they are looking more widely, not limited to the infrastructure, but they are also looking at the different segment of the market and then different like various like asset class, because they understand that yeah, in Japan, like given the still relative to the other countries, like relatively limited pool of asset that you can choose for the investment. So they are more like opportunistic on which asset instead of what like being limiting to the specific asset class or industries.
Great. Azusa, thank you so much for your time and for this the great landscape overview of the Japanese private equity market.